And let me do a quick introduction to the group here. So they all knew you were coming, and so I'm gonna kind of frame it on how Brian and I actually hooked up. The reality is that my life insurance agent decided to cash out on his own, and passed away.
Oh.
So sorry, can we make jokes? We can
Yeah.
make jokes. Brian is like, what am I stepping into? Um, but Brian happened to get stuck with my policy, and he called me up just to introduce himself. And the conversation went about to I am in my mid 40s at the time, and I have no financial planning at all. I have no investments anywhere. I have no retirement funds. My whole plan, my whole life was to build a business up and then at some point sell it. Which COVID kind of put a kibosh on that, and I realized that that on its own is not a good plan. So you guys know the saying: the best time to start to plant a tree was yesterday. The second best time is today, right? So I got with Brian, and what I told Brian from the get go is I'm big on learning. I don't mind you running and managing my finances, but I want to understand what you're doing and why you're doing it. And we spent probably an hour and a half in your office. He gave me all the time, never rushed me or anything, and explained what's the difference between an IRA and a Roth IRA, and what's the difference between this investment and that investment and different vehicles. And this is what he thought I should do and why. Even my life insurance apparently is not ideal. We since changed a few things. So I like Brian a lot. I like the way he approach things. And I'm just gonna leave one more thing before I'll turn it on to you, Brian. But um, everybody knows with the elections, everybody was pre-election, certainly post-elections about okay, what's going to happen with money and so forth, and what's going to happen with the markets. And Brian and I got on a call before, after the elections, but before Trump took office. And we're talking about it. It's like this is what I foresee happening. This is what I think is going to happen if it goes forward with the tariffs, stuff like that. And I'm making these adjustments to your portfolio accordingly. And I haven't seen the last statement, but the statements prior to there wasn't everybody that said they got hit with the stock dropping really didn't affect me. So whatever he did well, and I appreciate that. So Brian, let me kind of kick it off with some questions, and then I'm going to open it to the crowd because I really think this is one of those that everybody's going to have a slightly different situation or questions that concern them. But there's a variety of vehicles for investment nowadays. The majority of people in this room are about my age group and so forth. So assuming you are new into this, right, and you just want to start putting some money aside, what are some vehicles that make sense?
Yeah, no, look, that's a great question, and a question I get quite a bit. So I think what's important to realize is the government has incentivized you to save and set aside for your own retirement. And the way they've done that is with the one lever they can pull, and that's a tax lever. So what they've said is, hey, we're going to create pretty advantageous ways to defer taxes or to never pay taxes again. So it's essentially create a series of one tax buckets. And now they all have limits and they all have caveats, but suffice to say, the government's program, we call these qualified accounts, meaning they're qualified under the IRS code. And the government said, you know what, we tax money all the time. We're going to elect to only tax this money once. We're going to tax it on the front end or the back end. So everyone's probably heard of a 401k or a Roth IRA or maybe a traditional IRA. And there's a number of different vehicles that allow this. But the basic concept is that with a typical 401k contribution, for example, the government enables you to put up to $23,500 a year per person. If you're under the age of 50, you can do up to 30 if you're over the age of 50, or 30, actually almost 31. And you can put it away pre-tax, meaning you're not going to pay taxes now. The money grows tax deferred. What's that mean? Well, you're invested in the stock market. We can make trades inside the account. You can buy something for 100, sell it for 1,000. You're not going to pay taxes along the way. The only time you're going to ever pay taxes on that money is when you pull it out. Why is it then? Because remember, you put it in pre-tax. So I'll give you a real easy example. Let's say you make $1,000 a week and you want to fund something on a pre-tax basis. Then you can say, okay, well, I want to put 10% of my income this week on a pre-tax basis. So $100 would go into the account. You're only taxed on the remaining 900 that you earned. So that 100 you never had to pay taxes on. That'll grow tax deferred up until the age 59 and a half is when you can start withdrawing it. You don't have to start then. You can certainly wait till 60, 70, whenever you're in retirement. And when you start pulling the money out, you'll pay taxes then. Conversely, anything with a Roth designation, What that basically means is Senator Roth came out with a way to really help lower to middle income folks, and then it's applying now to higher income folks, where you can do the exact opposite. So you can pay taxes now on the money and never pay taxes again. So in that same example, you're making $1,000 a week. You want to contribute 10% of your pay, for example, into a 401k. What most people don't realize is that the vast majority of 401ks nowadays allow you to pick and choose how you make your contribution. You can make it pre-tax or you can make it Roth. If you make it Roth in that example, you make $1,000, everything gets taxed, and then your $100 goes in. So you've already paid taxes on the money. That grows tax deferred. As long as you wait till 59 and a half to pull it out, that money and the growth thereon, most importantly, comes out completely income tax free. So people always ask me, what's better, pre-tax or Roth? And the answer is really, it depends. You have to make certain assumptions when you're planning for retirement in that regard, and specifically whether you believe you're going to be in a higher income tax bracket now, or you're going to be in a higher income tax bracket in the future. Now, a lot of people, when I say this to them, they're like, well, Brian, that doesn't make any sense whatsoever. Why would I be in a higher income tax bracket in retirement than I am during my wage earning years? And the reason is because one of the catches with that 401k we were just talking about, that a lot of people have access to, it's available through a lot of employers. Even if you're self-employed, you can do things like solo 401ks and put up to $70,000 a year if you wanted to away, obviously the high end. When that money comes out, anything you've contributed on a pre-tax basis is treated as ordinary income when you pull it out. So in the eyes of the IRS, let's say you do a really good job saving, and let's say you save up $1 million for retirement, and you're starting to pull the money out in retirement, and maybe you pull out $100,000 in 1 year. The government will, for all intents and purposes, when you file your taxes, you have to indicate you made $100,000 that year because you pulled it out of your pre-tax account. So you will be taxed on it accordingly. So for some people, depending on how well they save, maybe they've put a lot of money back into their business along the way. Maybe their savings along the way, is not de minimis, but not maybe as much as they want because they're growing something on the side, a business, a real estate empire, whatever it is. When you get to retirement, maybe you have a liquidity event. You sell the business, you put a bunch of money away. When you start pulling that money out, you are going to have to pay income taxes on it. And you could theoretically be in a higher income tax rate now, or excuse me, in the future than you are now, which would suggest that anything with a Roth contribution now, again, paying taxes now, never going to pay taxes again, may be more advantageous. Another reason that I like Roth is because right now, does anyone know what the highest marginal income tax bracket is? Any takers? It's right now it's 37%. So up until 2018, when Trump put out some tax cuts, it was 39.6% is the highest marginal income tax bracket. And I'm just using the highest just for purposes of an example. Anyone want to take a guess what the highest rate has been really in the past 50, 60 years? Any takers on just a wild guess what the highest marginal income tax bracket may have been? And I'll actually give you a date. It would be in the early 80s was the highest it's ever been.
25%. 64.
64, really close. 70% was the highest marginal income tax bracket, which is absurd, right? So the government's keeping 70% of every dollar you're making, 70 cents they're keeping. The reason I bring that up is because I think there's a precedent, right? There's a precedent of the government charging high income taxes. Right now, if you watch the news, and every 4 years in particular, you're going to hear one party talking about raising taxes, one party talking about lowering taxes. But the consensus sort of seemingly tends to be that maybe high income folks should have to pay more taxes. That's not my personal belief, but that is, sort of what we've seen a lot of. And if you ascribe to that theory that maybe the government is going to increase tax rates in the future, then putting anything away on a Roth basis right now is almost like a form of arbitrage, right? You're doing a little tax arbitrage. You're saying, yeah, I may be in a higher income tax bracket now, but I don't like the unknown. And you'll find, we'll talk about it probably a little bit later about the stock market and what unknowns mean there. But when you have an unknown, it tends to make you act a certain way. And there's three courses of action, right? You take the action, you take a middle ground, or you don't take any action. And when you're thinking about this possibility of higher tax rates in retirement, if you're on the more conservative side, you're more of the sure thing side, it may be advantageous, even if you think you're maybe in a lower income tax bracket in the future, to still put away some of your money on a Roth basis. So this was a long-winded way of kind of going back to the 401k. And really with a 401k, does anyone not have a work and not have a 401k available? Show of hands, anyone? A couple people, a few people don't have a 401k. Um, and is that because you're
A bunch of people here, Brian, are self-employed, so that is one of the caveats. So a lot of them, very much like myself, are not.
Oh,
They
you're
don't
going to
have any
make my
contribution.
job so much easier. This is so much more fun then if you're self-employed. Okay. So if you're self-employed, what a lot of people think is they're like, I don't have a 401k because I don't have a big employment group. I don't have a group I can, ascribe to their plan. If you're self-employed and you're your only employee and you only have part-time employees but no other full-time employees outside of immediate family, you can actually do something called a solo 401k. So with a solo 401k, you're both the employer and the employee in the plan.
So you
What
can
that
double dip.
You can double dip and you can be very generous to yourself on the employer match you give yourself, right? So in those plans, or going back to the question I'd asked that led to this, and I'm going to kind of try to tie it all together. In those plans or in plans that you have through an employer, what most people fail to realize is that you can actually pick and choose how you contribute to those plans. You can typically choose whether you fund them on a pre-tax basis or a Roth basis. And a lot of people, I'd say 90% of people I meet with, have no idea that a Roth is even possible. Some people tell me, well, Brian, I've heard about the Roth IRA. I know the Roth IRA has income limits. If I make more than a couple $100,000 as a household, I can't fund a Roth IRA. That's not true. There's something called the backdoor Roth IRA, which may or may not be outside the scope of what we want to kind of go down that rabbit hole tonight. But suffice to say, there are ways working with a good financial advisor, you can get around that income limit to let you fund a Roth IRA, even if you make too much and you think you're unable to do it. But with a 401k, again, most people, 90% of the people I talk to, have no idea that they even have an option. The way it was historically done is every cent you contributed was done on a pre-tax basis, thus paying taxes when you pull it out. Or yeah, when you pull it out. So what my normal recommendation is for folks is that if you have one of those employer sponsored plans and you're funding the 401k, even if you think you're going to be in a lower income tax bracket in the future, put 30% away on a Roth basis, put 70% away on a pre-tax basis. So whatever you're going to contribute, just break it up like that. Again, even if you think you're going to be in a lower income tax rate in the future, because that's basically a hedge, right? We're saying we don't know what the government's going to do. We don't know if they're going to reach into our pocket more. We don't know if they're going to tax us more in 10, 20, 30, 40, 50 years, whatever it may be. So that is a way to kind of harvest your tax rate now, and then you're not subject to any increases that Washington wants to do. Now, let me come back to the solo 401k because because now I know that a lot of people are self-employed. This is going to be a lot more fun, at least for me. Maybe it'll get a little overwhelming for some, but there are so many more
Well,
things you can
let
do
me
as a
tell you this,
business
Brian.
owner.
Sorry. Don't give them everything because I wanted to go to you after the call too, right? Just tease them.
Trust me, the stuff we're talking about gets pretty complex, and they need a good financial advisor in their life, whether it's me or someone else, to help them out with it. But so there's so many cool things you can do. So one of the things, I already mentioned it was a solo 401k. So again, you could be your own employee and employer. If you are self-employed, again, solely, you're the only employee in the business, or if all your other employees are part-time or immediate family members, you can fund up to $23,500 a year on an individual basis. Plus, you could put in another 46.5 or so on an employer basis as a profit sharing contribution. Now, why would you ever want to do that? Because
You can
from
write
the
it off.
employer side, you're writing it off. Yeah, it's a tax deduction. It's a pure tax deduction for you on the employer side. So you can actually bring yourself down to a lower tax bracket. You can show less income to the IRS, and this is completely above board, and you're still getting to keep the money in your pocket. So for a lot of people like that, maybe, if let's say they have a great thriving business, they're making a pile of money. Well, maybe we will fund the $70,000 into it. If not, fund any amount you can. If you're a fledgling business, if you're a startup, if you're just getting things going, put any money you can away into a pre-tax bucket or a post-tax bucket, because something called compounding interest. I've actually got a little slide. BK, can I show this? Can I share my screen? Is that possible?
Yeah, let
I
me.
got it. I got it right here.
Right. Perfect.
This is just showing an example of
That's
compounding
because you're younger
interest.
than me. No, just kidding.
Are you seeing this now?
It is true. Yes, we can see the slide. You want
Okay.
to take us through it real quickly, though?
What's that?
You want to explain the slide, though?
Yep. So we go through it. So this is compounding interest. And a lot of people don't fully appreciate the modern marvel it really is. Einstein called it one of the greatest things known to man. And he's attributed to that. Who knows who really said it, but people usually harken it back to Einstein. In this example, all we're showing is $1,000 investment, earning an 8% interest annually. 8% is a relatively conservative amount to expect on an annual basis. if you're pretty aggressive in your portfolio, you should expect somewhere between, call it 8 and 14% on an annual average rate of return basis. But if you look at this, they put in $1,000, and over the course of 30 years, without putting anything else, it grew to 10,000. So, take that to the next level. Let's say that you were able to put in $10,000. What would that grow to? That would grow to $100,000. What if you were able to put in $100,000? That would grow to 1 million in 30 years. And there's an easy way to figure out, a little party trick you can use. It's something called the rule of 72. So if you're trying to figure out how fast your money will grow and how much it'll grow to, if you divide the anticipated rate of return into the number 72. So let me give you an example. If I expect to get 10% average annual rate of return, then I know that every 7.2 years, my money will double. So if I put $10,000 to work, then I'm getting a 10% rate of return, and I plan on working for 28 years. See, I'm making my math pretty easy. I get 4 doubles. That $10,000 grows to 20 is the first double, to 40 to 80 to $160,000 in the course of 28 years. So you can see how compounding interest really, really works, and it works really well. Anything you can put inside a 401k, for example, not only is it shielded from taxes, but you're going to get that compounding growth on it. So going back to what I was talking about with self-employed individuals, solo 401k is low-hanging fruit, great way to shield money from taxes from the IRS, and great way to save up for your future. There are also things called defined benefit plans or cash balance plans. Has anyone ever heard of a cash balance or defined benefit plan? So these are the perfect solution or perfect situation is self-employed individual. Small businesses, if you have a handful of employees, particularly if they're the younger side, that's another good way. And there's a reason for the younger side I'll touch on here in a second. But think about it like this. If you think back to maybe parents or grandparents, maybe you heard people talking about pensions, right? So pensions used to be really popular. The government still issues pensions. Some of you may be getting a pension right now. Basically, what it is if you agree to work for a
Just look at
company
you.
for a
The
specified
answer.
period of time, they're going to say, okay, well, you work for the government. Maybe you retire on 2/3 of the last, the high of the last 3 years' pay. So whatever it is, it's just an amount they're going to pay you for the rest of your natural life if you retire at 65, let's say. Now, how does that actually work? The government doesn't, it's called a defined benefit plan. And what the government does not define is how much money they're putting into it. That would be a defined contribution plan. So think 401k. We're defining how much we're putting in. What it grows to is up to the market, right? How you invest it, what's going to happen, defined contribution. Defined benefit, all we care about is the end result. So how much am I going to get at a future date? So when you heard, maybe some of you, I know it's a lot of younger people or middle-aged people, probably about my age in this room, probably back in 2008, you may have heard the horror stories about underfunded pension obligations. These were by state governments, these were by big corporations, where they had these pensions and they were supposed to be putting money into it for folks every year. And when the economy fell out, 2008, they said, okay, the legislature looked around, we're going to not fund the government this year. We're going to hope that the growth makes up for it. We can still meet all our future obligations of having to pay people 2/3 of their salary for the rest of their natural life. Well, invariably that failed. And so we saw a lot of police officers, we saw a lot of firemen, a lot of people get hosed in the sense that they had underfunded pension obligations and maybe they had to take a reduction in what they were expecting. So this is someone that's worked for 20, 30 years, expecting a certain payout in the future. Now they're not necessarily getting it because the government underfunded it. Well, private businesses used to do this as well. And in large part, since probably the mid 70s to early 80s, we saw a real transition away from these defined benefit plans, again, paying a pension later on in life, to defined contribution. Hey, we'll give you a match. We'll give you a 3 to 4, 5, 6% match into a 401k. But whatever else you put in and what it grows to, that's up to you. They sort of pass the responsibility of saving for retirement onto the employee, not the employer. So why do I bring this up in the case of self-employed individuals? Because you can actually create your own pension plan. And so by creating your own pension plan, it's a pure, I mean, I want to say it's a pure tax play. It's not pure tax play. It is the major impetus for it is taxes. What you can actually do is you can sock away up to, and again, these all these numbers I'm going to give you are the maximum limits. It's not suggesting this is what everyone in the room should be doing or anything like that. But you can be putting away up to $250,000 a year, pre-tax, complete tax write-off, each and every year by funding your own pension plan on top of the solo 401k. So maybe about 300, 320 is what the maximum to do. Again, I don't expect anyone to be like, oh, that no problem. I'll put $320,000 away for retirement every year. But I bring this up again just to give you what the maximums are. Now, this is an interesting game when you do this for yourself because remember, the real reason we're doing it is for that tax break when we're putting the money in. So you are limited to like $2.5 million is the most you can save up inside this account for this future pension you're paying out yourself. So what we have to do in order to get to that 2.5, how can you get there? You can get there through funding it, putting money in, or through market growth in the account, right? With these plans, what we're really trying to do is we're not as concerned about growth as we are on saving taxes right now. So we intentionally dial back the risk. We dial back the growth in these accounts. We only want around a 4 or a 5% average annual rate of return. Why? Because remember, all we're trying to figure out is what it's going to pay in the future. And we can have an actuary, a person whose job it is to run those calculations and figure out what it's going to grow to in the future. You have to file an IRS form every year showing you have your own pension and everything like that. But if it grows too fast and we get a 10% rate of return one year, well, the next year you may be limited to how much you can contribute. Now the max isn't 250, maybe it's 175, maybe it's 150. And if your goal is to save as much in taxes as possible, you kind of want that slow and steady growth. So every year when you look at it, it's like, no, great, you didn't hit the limit. You're projected to be right on track for that 2.5 million or whatever it is by age 65. So we'll let you put in the full 250 and up to that. But the basic principle is it is a much more conservatively growing account that not only is it pre-tax, so it grows tax deferred, but after you terminate the pension, so let's say you get into it for 7 years, 10 years, 15 years, however long you want to run the pension for yourself, you can then roll it out into an IRA, and there's no tax consequences for doing that. We put it in an IRA. Now we really try to grow it. So we may only wait 7 years of doing this slow and steady just to get these maximum tax breaks. And then all of a sudden, we're pulling it out of the plan, we're putting it in an IRA, and now the sky's the limit. We're really trying to grow it. So this is another tactic that we use a lot with self-employed individuals, particularly small business owners or even single employees. So if you're your own boss and you don't have any employees, this is a great mechanism. The downside, the catch, is that if you have a larger company with these defined benefit plans, they have to go through what we call a compliance and discrimination testing. That's an actuary we bring in and a third party administrator that actually every year has to do almost like an audit on the plan. And they will look to see who is participating in the plan. If you have 15 full-time employees and they're all similarly situated, let's say you're BK and you have 15 instructors that are working full-time for you, 40 hours a week, you have them on payroll as W-2, he has to make that plan available to them typically. The problem is most of these contributions are being made by the employer, not the employee. So if you have exceptionally young individuals, it may be okay to do. Why? Going back to the whole point of a pension, really it's to get you to that age 65, then allow you to start taking withdrawals. The younger you are, the less amount of money you have to put in to solve that math equation to get you to the number at the end, whatever that number is. The older your employee is, the less time they have to save up. So the more money you'd have to put in, right? Does everybody follow me? This is a complicated topic, but does everybody follow me so far?
A lot of math. Yes. Luckily, most of us are Jewish, so we're getting it.
So this is another great way that self-employed individuals can essentially stop giving up so much of their hard-earned money to the government, and instead put it back into their pocket and have it grow and work for them for the future. It's a phenomenal way. There's other ways. We talked about Roth IRAs, for example. Roth IRAs are great because, again, you can put in up to $7,000 per person into a Roth IRA. This is a separate limit from the 401k, forget cash balance plan. This is completely separate.
So all of these are individual vehicles that they can all be multiplied and compounded on each other, right? So you can run all of them.
And they've got to all work in tandem with one another, because there's certain things you can do. Like, for example, if an individual, here, let me look up what the limit is. I haven't looked at it in a while. But Roth IRA income limits for 2,000, it's usually 200 some thousand. Yeah, it's $150,000 as an individual or 236 as a household. If you make more than that in a given year, you are unable to fund a Roth IRA using the organic method. The organic method being you take up to $7,000 a year and you put into a Roth IRA. You've already paid taxes on the money, so it comes out of your checking account, your savings account, where you've already been taxed. It goes in there, it grows tax deferred as long as you wait till 59 and a half to pull it out. That money you put in, plus all the gains, it may have gone up 4 times in value, 5 times, 6 times in value. Everything comes out to you completely income tax free. But if you make more money, the government's like, we don't want higher income earners being able to avail themselves of this one tax bucket that's pretty sweet. So I alluded to the backdoor Roth earlier. And when you're doing all these different things, the solo K, the cash balance, the if you make too much money for the Roth and we do the backdoor Roth, you need to make sure you're not creating any footfalls for yourself. What I mean specifically is the backdoor Roth is a loophole in tax law. I know you're probably thinking, hey, here's this attorney and financial advisor talking to us about a loophole. Sounds shady. I'm running for the door. It's not. It's completely above board. The backdoor Roth was codified really in 2007. The government, if you remember back in 2007, we had an economy kind of circling the toilet bowl. We had wars going on in multiple countries. We had the housing market collapsing. We had the financial market collapsing. And 2008 was an election year. So the government was looking around like, what do we do to raise money without calling it a tax? We do not want to call a tax when people are hurting financially and when we have an election year coming up in 2008. So what they did is they said, okay, well, we have all these people with 401ks. And when they have 401ks, when you leave an employer with a 401k, you have four main options. You can leave the money where it is in that old employer's plan. Most people don't want to do that. You can cash it out. And if you cash it out and you're below the age of 59 and a half, you're going to pay a 10% penalty. Plus, you're going to pay income taxes on everything you cash out. Again, not a great idea because you've got this really special bucket of money that's growing pre-tax or post-tax, and it's going to grow for the long term to be there for your retirement. So you typically don't want to do that. You could also roll it into a new employer's plan. So let's say you're a W-2 employee, you leave one job, you get hired somewhere else, you can roll your 401k right into that plan. But the fourth option is by far like 90% of people pursue. It's called a rollover IRA. What that means is when you leave an employer with that old 401k, you take the money away from your employer, you put it in an individual retirement account that you and your financial advisor can manage. So you're taking it out of the employer plan where you may only have 20 or so options to invest in. Now it's an individual account. You can invest in anything. There's no tax consequences for doing that. It still keeps the pre-tax nature. It just rolls right in. So what the government found is that there were trillions with a T, more dollars in rollover IRAs than there were in active 401k plans. And ostensibly, if people have been funding this on a pre-tax basis, at some point in time, they're going to have to pay taxes on the money, right? They start pulling the money out for retirement, they're going to pay taxes. So the government kind of looked at it in 2007 and they said, why don't we look at this like a farmer may look at a field? I can harvest my crop early. My yield, what I get, will not be as great, but I can certainly harvest it early if I need to get cash in the door. So the government said, we've got a great idea. What if we allow anyone, irrespective of how much money they make? I don't care if they make $1 billion a year. What if we allow anyone to convert a pre-tax IRA to a Roth IRA? The only caveat is that year they convert it. So you leave an employer, you have $50,000 in a 401k, you roll it into an IRA. Hey, great news. You can go ahead and convert it. If you convert the entire thing in the eyes of the government, you made $50,000 more that year. So you have to pay taxes on the entire amount. What did the government solve for? Getting cash in the door right now, right? They were watching, again, the economy circling the toilet bowl, the wars in multiple countries, election year. So this was not a tax. This was a great financial, savvy financial transaction that more affluent investors could pursue to try to get that money tax-free from this point forward. So I'm going to go ahead and pay taxes now, essentially paying taxes on the seeds as opposed to paying it when I pull it out on the future harvest. So what's better to pay taxes on? If you ask any farmer, is it better to pay taxes on the seeds they put in the ground or the harvested crop? As long as weather cooperates, I think it's probably the harvested crop. I mean, excuse me, the seeds you want to pay taxes on, not the harvested crop. Same thing would apply here with that Roth bucket. But when the government did this, they need to raise revenue quickly. And when they passed the bill, they left this gaping loophole. And this gaping loophole basically created the backdoor Roth in 2007 and in 2008. It allows anyone, forget the income limits, anyone with certain caveats that I'm not going to go into. You really need to talk to a financial advisor or CPA about the caveats. Yeah, I think it would confuse everybody for purposes of tonight. But you're allowed to put money into what we call a non-deductible IRA. So you take money out of checking, you take it out of savings, you put it in this non-deductible IRA, and then we convert it to Roth. But remember, we're taking it out of checking or savings. We've already paid taxes on this money. Because we're converting money we've already paid taxes on, there's no secondary tax consequence. We literally just evaded the income tax limits without paying any extra tax on that. And that created the backdoor Roth IRA. So it's a loophole to existing tax law. But the reason I bring this up is a lot of people pursue this. In fact, I have a lot of people, a lot of investors that start working with me and they'll give me their statements and we'll look at them and they've been doing the backdoor Roth IRA for a number of years. And I'm like, wait a second, You should never have been doing that because there's a caveat. There's a pre-tax IRA, a simple IRA, something that would disqualify them from being able to pursue this loophole. So the reason I even bring this up is to BK's point. He was talking about all these working together. Yes, they do all work together. It's really important to find a good financial advisor. I don't care who it is. Find somebody you like and trust. Have them coach you through it. Have them do it for you more specifically, because they can make sure that you're not going to run into these footfalls. They can actually trigger double taxation in the future. So the name of the game, really, when we're working with clients or any good financial advisors work with a client, is save as much in taxes now as we can and have as much growth for the future value as we possibly can. Using these strategies in conjunction with one another, particularly taking advantage of what the government's allowed us to do from a one tax perspective, really, really works out extremely well for a lot of people. Now, what about people that are like, look, Brian, I like the idea, but I've got a 5, 7, 10-year time horizon, and I'm 37 years old. You told me I had to wait till 59 and a half to really start pulling money out without a penalty from these accounts. What do I do there? Most of my clients are not just stopping with the government qualified accounts and what we can do there to the extent they're eligible. There's different criteria. Again, if you have a business with 15 or 20 employees, you may not want to do a cash balance or a pension plan because it's going to be too expensive to pay for it for your employees. So what do you do with extra savings, and how do you grow it for retirement where your time horizon, when you're going to need the money, may be somewhat indeterminate? A great thing to do there is you put it in what we call a taxable account. It could be a joint account. It could be a transfer on death account if it's an individual account. Different types of accounts that's nothing more than just a stock market account. Think of it like that. It could be called a brokerage account, for example. What you're doing is you can put any amount of money you possibly want into there. It's all going in after you pay taxes on it. When you sell a position and you realize gains in a position, that's the point in time when you're pay taxes on those gains. Those taxes on the gains, as long as you've held it for more than 1 year, are less than most people's ordinary income tax bracket or ordinary income tax rate. They can be anywhere between 0% and 20%, depending on how much money you make. If you make over $600,000 a year, I think you cap out at around 20% capital gains tax for long term, much less than the same person who is making $600,000 and paying W-2 taxes and paying the federal and state income taxes. So there are ways that you could still save and set aside for retirement that have no requirement to let the money sit there. You can pull it out at any point in time for any reason or no reason. But the goal would be to grow as much as you can. So if someone's saving up for a beach house, if someone's saving up for college or something like that, 529s, which we can certainly talk about, are a great way to save up for college. Brokerage accounts can be a way if your state doesn't give you a state income tax deduction. But there are a number of different ways you can use a brokerage account that you do not have to wait till 59 and a half to pull it out. Does everybody kind of follow me so far? A little bit more
it's a
or less.
lot of information. So Brian, I wanna kind of shift a little bit with your permission, and just because I know your time is valuable, and this could easily go like when you and I sat in your office for a long while,
I
right?
could be here till midnight if you guys want to hang around.
And some people will probably still be here drinking at midnight because that's what we do on Wednesday nights. But
What were we doing?
but this is what I want to use your actual farmer analogy, right? About, you said about being taxed on the seed rather than the crops and so forth. But the one caveat is when the weather cooperates, right? And I think right now everybody's very worried about the weather not cooperating, right? So,
Yep.
What is, and I always tell people, I mean, investing in stocks, whether it being a retirement account or just, brokerage account or whatever, it is a gamble in a sense, but you can minimize risk, right? So what are some advice that you would give people that want to get into investing but are worried about the current climate?
Yeah, that's a great question. So I would say, this chart, and you can get this anywhere. This is not like a proprietary chart. This is right from fedprimerate.com. This is showing the S&P 500. Let me make it a little bit bigger. So really what we're looking at is we're looking at the S&P 500, which is a stock market. It's just a stock market index. It's what everybody uses to say, what is the stock market? It's the S&P 500. It's the 500 largest companies, market weight basis. It's different. People have always heard about the Dow Jones Industrial just because it was the first. That's 30 industrial companies, not really representative of the overall economy, overall stock market. The S&P is, and the Dow would look similar. But just to show you an example, if I zoom in a little bit, you can see not much going on back here. Probably wasn't great to invest, but we're really starting at zero. And if you think about it, you're getting up to, by the time you get to 500, from 1959 up to 1993, so around 40 years, not even 40 years, you're seeing it grow by 500 times. So even though this looks boring, That's still a 500 time growth ratio. If you look at what happened, think back to 2008. There's 2008 right there. See that dip right there? If I look fast forward to something more recent, to what happened in 2020, COVID. Here's COVID right here. See the dip right here in the S&P 500? And all of a sudden it starts building back up. Then what happened in 2022? Got carried away, the rebound from COVID, pulled back. What do we see happening right here? Here's the dip we just had right there in March and April and in the early part of May. Here's the dip right here. This dip, I was actually, my business partner and I were looking at this today. This looks a lot like the COVID dip, doesn't it? It's almost identical to it so far. What I can only hope is that the market will rebound the same way. What I can tell you, BK, to your point, investing is scary for a lot of people in the sense that they're not used to taking risk, and they're not used to having a lot of money. It's a little bit out of their control. You can control allocation, but you can't control what's going to happen on a given day. And even a good financial advisor, if they tell you what's going to happen, they know for certain what's going to happen in the market a month from now, they're lying to you or stupid. So it's really not possible. So what's the important part? The important part is, you look at studies that have been done over a long period of time. If I look at the S&P 500 over any 30-year period of time, it's averaged just over 10% average annual rate of return. Now, that doesn't mean that there's not going to be ups and downs. But if I look at the overall rate of return, it's closer to 14% when I factor back in dividends you're getting paid along the way. What's that really mean? It really means it comes down to more behavioral economics, because a lot of people in the room may have invested for a little while. Maybe you got caught up in the COVID craze. Maybe it was 2021, you invested in a bunch of tech stocks, or you got into something else and it's gone up and down and volatile. The important part is to start early and stay consistent. The market should go up over any long period of time, but about 3 or 4 out of every 10 years, we expect the market to be down. So 30 to 40% of the time, the market should be down. We just turned positive for the year. The market's up 3% or so for the year, the S&P 500. For a while, it was down rather considerably. We were down almost 20% off the November high in the S&P 500. So you had people, let's say you had $1,000 in the market, you lost 200 of it between the end of November and the beginning of April. That's never a good position to be in, right? A lot of people called me during that time period and were freaked out. They were scared. But what do we do? How do we combat that? I think there's a few different things. So one, to the extent you can, you really should try to dollar cost average your investments, particularly when the market's going to be volatile. What's that mean? You make regular periodic investments into the same underlying set of securities. So real easy example, 401k. If you have a W-2 job and you're funding your 401k, every 2 weeks when you get paid, some money comes out of your paycheck, goes in your 401k, set it and forget it. That's dollar cost averaging. You've already picked your investments. It's just buying the same things. So as those investments go up and down in value, you're able to buy at different price points. So dollar cost averaging can be very helpful. The second thing is you can't be emotional with your investments. What the studies have found, if you read any white paper on the value of an advisor, I would argue, and I think a lot of advisors may disagree with me, I would argue that the main value of a good financial advisor brings is not just performance. That's secondary. It's behavioral. It's a lot to do about education and someone's behavior. So when I had clients calling me in April 2nd, April 3rd, that first couple of weeks and the market was just falling off a cliff, I had 20, 30, 40 clients contact me and said, I want to stop all investing. I've already stopped my 401k contributions. I'm not putting any money in the market. It's going to zero. The first thing I tell them is if the market goes to zero, we got a lot bigger problems than your investment account. We're trading liquor and bullets to survive. I mean, think about any apocalyptic type scenario. Exactly. Those are the two. That's my theory. Is those are the two forms of currency if we do have a situation like that. So the second thing is what people tend to do is they tend to get emotional. And with a financial advisor, all the studies have shown you get about a 3% better net rate of return after fees by using an advisor, even using the same underlying investments. It's behavioral. So all these clients that call me when the market's pulling back, I have to stop them. And I say, let's look. Has your risk tolerance changed since we set up the account? No, Brian, my risk tolerance hasn't changed. Okay. Are you retiring early? Do you need the money earlier than you originally told me? No, I don't need any earlier. Then what has changed? Have your goals changed? No, the goals haven't changed, but I'm spooked about the market. And what I always implore people to do is you've got to take that emotion out. That's the worst thing you can possibly do as an investor. There was a study done about missing key days in the market, and they found that, again, about a 10.1, 10.2% long-term rate of return in the S&P 500. If you missed the 30 best days, your rate of return was something like a negative 2% in that same time period over 30 years. So just missing the 30 best days in the market, those rebound days, have that big of an impact on your overall rate of return, take you from a 10% positive to a 2% or so negative. It's about staying consistent, staying in the market. When things are pulling back, as long as you have a good portfolio, you're not buying, you're not caught up in the whole GameStop frenzy that happened a few years ago and the meme stocks and all that nonsense. As long as you have a well-diversified, robust, good portfolio, you should not let the day-to-day market activities change anything you're doing whatsoever. In fact, what history has shown us, if we look back at the chart, when would be, you guys tell me, when would have been the best times to invest in the stock market? I would have loved to invest. If I felt comfortable investing right here, am I comfortable investing right here? What about in COVID? If I was comfortable investing in 2019 and really up to March of 2020, and I was comfortable investing right then, why in the world would I not be comfortable investing when everything's on sale? It's like I wanted to get a new iPhone and I walk in the iPhone store, they have them on sale, and I'm like, hard pass. I'm going to come back when they're full price. That's the exact opposite sort of behavior you want to take. And so really what I talk to clients a lot about when this market pullback occurred, as long as there was no change in circumstances, why are we putting more money to work? This is an opportunity to buy as long as your time horizon allows it. Now, what do I mean by the time horizon allowing it? What I never, ever, ever advise is for people to put money to work in the stock market if they don't have at least, or generally about a 3-year time horizon. I don't know what's going to happen in the next 1 year. I feel a lot better knowing what's going to happen in the next 3 years because of that, a reversion to the mean, historical averages. While they're not necessarily indicative of future results, it could give me a little bit of a barometer or a track record. I can kind of see what's happened during other periods of pullback. And so, if you're like, hey, Brian, I'm saving for a house and I need the money in a year, I would tell you you're crazy to put the money in the stock market. I would never do that with money you need in a year. Generally speaking, again, that 3-year time period is kind of the sweet spot. And that's also why with investors, with this volatility that's happening, what do I tell investors that are young? Again, keep putting money in. What about people that are in retirement? What are we doing then? We're taking a different approach. We've already crossed the finish line, right? We've already got our savings. We've done the accumulation phase. Now we're in the withdrawal phase. The last thing I like doing is holding a Black Friday sale on my clients' assets. I don't think any advisor appreciates that. I know clients don't like that. So we take much different approaches when there's market volatility for someone in retirement than we would for any of you that are in your business owning years, your wage earning years, your growth years. It's a much different approach. But with this current volatility, I would not let it sway you as long as you have a well-diversified portfolio. If you want to do all your own investing and just do something with it, take Warren Buffett's advice. Warren Buffett's probably going to go down in history as the greatest investor of all time. And his whole shtick was he always bought great companies, good, solid companies that made a good, solid product, set it and forget it. He is not what I would call an index-based investor, meaning he's not buying just the S&P 500 or the Dow Jones. He's buying individual companies. However, his financial advice to his grandkids, to the viewing public, to anyone is if you don't do anything else, just buy an S&P 500 index fund, set it and forget it. Hopefully the mean reversion occurs. Hopefully you get that long-term average of around 10%. Set it and forget it. Keep it simple. When you start picking individual stocks and you start picking individual companies, can you potentially get alpha? Alpha being market performance performance in your account in excess of just the broader market? Sure, you can, but can you also get losses? Absolutely. Under Armour is a great example. I used to, probably back in 2005 through 2007, 8, I used to buy Under Armour 3 or 4 days prior to every earnings call because they kept knocking it out of the park. I look at Under Armour now, I wouldn't touch their stock with a 10-foot pole. It's an abysmal company, as far as, I'm not saying anything about their quality of the products. But as far as the stock performance, it's been terrible. If I look at what used to be almost a blue chip company, Eastman Kodak, whoever thought Polaroids would go away or film cameras would go away, so when you buy these individual companies, all of a sudden you're taking a single stock risk. That becomes a little bit more problematic, particularly for investors without an advisor that's managing those single stock risks. So for anyone in the room that's getting nervous about the market, my advice would be dollar cost, as long as you have a longer time horizon, dollar cost average in the market, buy an S&P 500 index fund, buy a target date fund, something that's broad, that's diversified, and allow you to take advantages of these pullbacks.
Perfect. Thank you. So I'll have one more question and then I'm going to open it for other people. But a lot of times a question comes out about alternate investment. I know you and I had a conversation about thinking about buying real estate or buying other businesses or whatever, right? So other vehicles that are not necessarily stock centric, and you told me some of the concerns that you had with some of my ideas, right? And I appreciate you, pulling me off the ledge. But just my wife here is like, I appreciate it.
BK keeps me on my toes, that's for sure.
But by the way, remind me after the call. I do have to update you on a few things. But
for a couple days.
No, but not aside. So I see you have the slide already. So real estate just being one example, right?
Sure.
But anybody comes up with an alternate approach, right? What would you tell them?
Yeah, so that's a great question. So there are alternative investments in particular have become much more popular in the past 5, 10 years. And specifically, we'll leave real estate aside because a real estate, if anyone in the room is a real estate investor, that last slide may have made them a little angry to say.
That's
maybe
okay. Don't worry about it. Put it up.
But so let me talk about just alts. We call them alts, alternative investments, just in general. They become much more popular. They're pretty much, I would say, they're probably the most talked about in our industry type of investment right now. They become sort of sexy right now for a lot of people. People are looking to get into alternative investment classes. What are they typically like? You can look at cryptocurrency as being one. That's certainly one I would classify as an alternative type investment. Bitcoin, your Ethereum, your Doge, your Shiba Inu, if you want to get crazy. Cardano, Solana, different things like that. Then there are private equity type investments. Private equity simply refers to investing in companies that are not in the stock exchange. They're not publicly traded. The vast majority, so probably, I don't know the exact stat, I'm sure we can look it up. I bet you it's probably 95 or 99% or something, some crazy number of companies actually aren't publicly traded. We can't go out and buy the stock in them. Think about, if I wanted to buy into BK's business, I couldn't go to the New York Stock Exchange and buy into it, right? This is more of a, working on. Okay, we could definitely talk about that. So, these private equity type investments in particular has become exceptionally popular in the past several years, particularly because what makes it attractive is one, you're getting into companies potentially earlier on, maybe before they've gone public. So think about a SpaceX is doing private equity investments right now. They're not a publicly traded company by Elon Musk, but it is a growing company. Maybe it goes public someday. What are the advantages and the disadvantages? Sometimes it does afford you that opportunity to get into a company before it hits the big leagues, if you will. But there are a lot of multi-billion-dollar companies that are not publicly traded. They don't want to be. Why is that? Because when you're publicly traded, you have a lot more regulatory scrutiny. You have a lot more financial scrutiny. You have to adhere to a different set of laws that sometimes can be cumbersome or burdensome. So even some of these huge, 100, 200, $500 billion companies are not publicly traded. Private equity may allow you a way to get into investment with those companies. The downside to most alternative investments, I'm leaving crypto aside for a second, but think about private equity in particular, is that usually when you invest in private equity and you invest in a non-publicly traded company, you lose one key feature. And it's a really important feature for me. It's liquidity. If I want to buy a stock that's publicly traded or an ETF or a mutual fund or a bond, I push a button to buy it. I push a button to sell it at my leisure. With private equity, it's a different type of investment. You have to be what's called an accredited investor. So you have to meet certain income or net worth requirements to be able to invest. And once you invest, that money is out of your hands and you may have no ability to ever get it back, or certainly not for a number of years. You lose liquidity in private equity typically. That in and of itself makes it inappropriate for a lot of retail investors because, again, you have $100,000 you want to invest, you put it in private equity, and you're all of a sudden the roof needs to be replaced. You can't be like, I need $20,000 out to replace the roof. They're going to say pound sand. You put it in private equity, we'll dictate when we're going to give it out. Maybe it's some future liquidity event. They sell to a new company, they go public. Maybe you get your money then. Maybe you get an interest rate along the way. But you do lose a lot of control over making that money liquid. But that is one form. And frankly, private equity in 2022, when the stock market was down, private equity performed pretty darn well. We manage a lot of private equity investments, and we do it through companies like iCapital or First Trust or different companies that kind of go out there and they ferret out all the deals, the big deals that come up. They have certain criteria. They have private bankers that go out. They're meeting with a company. They're kicking the tires. They're figuring out what they're going to invest in. We give them the money and they put it in these privately held companies. That's a form of alternative investment. There's also an alternative investment that's become more popular, particularly with all the volatility as of late, called structured notes. You may not have heard of a structured note, but basically, BK, did we talk about these at all, structured notes?
No.
So,
I feel like you should know.
Well, not really. I like these for people that are in the income phase of their saving journey. So they're trying to generate income from their portfolio. And for people in retirement, like I talked a little bit about people that were calling me and they were savers and they're in the growth phase. For them, we keep doing what we're doing. There's no point to get shy now. Now's the time to buy. Now's the time to be greedy when everybody else is scared. For people in retirement that are deriving income from their portfolio, we don't want to be that aggressive. So one of the strategies we deploy for some folks, if it meets their objectives and criteria, goals, et cetera, risk tolerance, is we use these things called structured notes. Structured notes are basically us loaning money as an individual, loaning money to a bank. It may be Goldman Sachs, it may be Citi, it may be JP Morgan, it may be Bank of Montreal, BMO. But there are banks out there that are willing to pay you an interest rate and provide you a downside protection for getting use of your money. So let me give you an example. I'll make it easy. We'll do a 1-year structured note. So let's say you have $100,000 and you decide you want to go to JP Morgan or Goldman Sachs or whoever it is. And you're like, I want a structured note. I'm going to give you my $100,000. Here's what I want in return. I want to pick 2 or 3 different indexes. I'll pick the S&P 500, the Dow Jones, and the NASDAQ. So 3 big stock indices. I want 30% protection on my money. What that means, oh, and I'm sorry, and I want an interest rate paid to me every month for the next year. So maybe the bank says, okay, well, we can give you 30% downside protection. We'll give you a 1-year note and we'll pay you a 10% interest rate. So what does that all mean? Every month after you give them $100,000, they will look at the 3 indices you pick. Yes, like you can pick anything you want. You can pick an ETF, you can pick a mutual fund, but let's just stick with 3 indices. And let's just say that the lowest performing index there is the S&P 500 and it pulled back 10% in a month, which would be crazy, but it can happen, right? That's a correction. If it did, as long as it's not below the protection you wanted, a 30% barrier, they pay you your interest payment for that month. Every month, they look at it. From the time you bought it till right now, as long as it does not go below 30%, we'll continue to pay you an interest rate. At the end of the structured note, as long as we measure it 1 year from now and the market's not down 30%, we'll give you all your money back. What happens if the market's down 29%? You get all your money back. So what you've essentially done is you've gotten a 10% interest rate that whole year. The market was down 29%. You got your $100,000 back at the end. They took the risk. You shifted the risk to them. Now let's look at a different example. Let's say in that same scenario, the market went up 20%. What do you get
Brian, I have
back?
a question.
Yeah.
What happens if the bank goes out? Because we've seen banks collapse.
That is the credit risk, and you are definitely undertaking the credit risk, and that's why we only work with some of the biggest banks in the world when it comes to this. Kind of like the proverbial too big to fail banks. Goldman Sachs, JP Morgan, Citi. Those are banks that are so large that the financial ramifications from a collapse are much different than a regional bank, like a Silicon Valley bank, or something like that. So the concern, while it is still there, and that's a real concern, it's not as material in my mind as it is for certainly a smaller bank or regional bank. But that's a great question. You are assuming, and that in this example, you're assuming credit risk. So you're loaning the bank money. They have to be around to pay it when it comes time. So let's assume on the other side of the coin, the market goes up 20% in a given year. Well, if you left the money invested, you would have gotten $120,000 back. But you didn't. You gave the money to the bank, you loaned it to them, they gave you this downside protection, didn't matter, you didn't use it. They paid you 10% along the way. They keep the VIG, they keep the spread. So that's the fee associated with it. If the market does really well, you didn't need the protection. You got the interest rate along the whole time, but you didn't make as much money as you would. So who is this good for? Someone in retirement. They're getting spooked by the markets going up and down. They're like, look, I know I've got $1 million in retirement. I need $100,000 in income this year for my portfolio. This bank's willing to give me a 10% rate. I'm going to give it to them. I'm going to hope the market doesn't go down below 30% in this example. What happens if the market goes down 31%? You only get back 69,000 of your 100. You're dollar for dollar sharing in the losses. So you can, and people are like, well, wait a second, I don't know if I like that. It's like, well, if you put the money in the market and it went down 31%, you were down 31% anyway. At least you made the money along the way. So there are strategies, and this is a form of alternative investment to your point. There are strategies that alternative investments have become very popular for. Income strategies, private equity strategies, and then things like cryptocurrency type investments.
Okay, I'm not gonna go into crypto. You and I had this discussion, and I know it's a downward spiral that's hard to come out of.
It's a gamble. I look at crypto not as much as an investment as it is. It's an investment if it goes up, but it's too volatile to make me feel super comfortable. You have to have a very high risk tolerance to invest in crypto. So what I generally tell people, BK, I told you the same thing. there's nothing wrong with carving out a portion of your portfolio to be what I would call speculative. Maybe it's 5 or 10% of your overall portfolio value. And if you really are hell bent on saying, I love crypto, I'm really bullish, great, put some money into it, but try not to make it any more than 5% or 10% of your overall portfolio. That portion, in other words, that you can afford to take that really large risk, and you have to be able to stomach the ups and downs. I mean, we watch crypto go up to 69,000, fall back to 17,000, at 23,000, then go up. I think Bitcoin hit 110,000. So it's one of these deals where it goes up and down. It's made a lot of people rich. It's lost a lot of people money. From an investment standpoint, I can't get behind taking someone's entire net worth or a large portion of their net worth and putting in crypto, but certainly 5-10% for the right investor, I think that's appropriate.
Awesome. So I appreciate all of that. That's a lot of information. So I want to open it to other people here, not just a few people with questions. I'm going to switch my view so I can see everybody. Who wants to go first? Yep. Go ahead, Kathy. Can you hear Kathy?
Yeah. I'll tell you 1 second.
Okay. Here.
You got to talk.
Yep, I got you now.
I work for a large fire department, and we are large enough that we can support a very healthy pension system, as well as, are you familiar with drop programs?
Yep.
That I've been in my drop for 4 years. I got 2 years left. I'm guaranteed 4.25% on the drop program. And my deferred comp, basically my public safety 401, is earning more than twice that over the 24 years that I've been in.
Yep.
Would it, because I know obviously with I'm guaranteed the 4.25% only in the drop program, would it be more beneficial to roll that over into my deferred comp once I'm done in 2 years, or kind of keep
that's
that
a great question. I get this question. Actually, I work with quite a few firefighters.
Yeah.
So this is a phenomenal question. So what the drop program is remember we were talking about that defined benefit plan versus defined contribution, and you're talking about your 457. So for everybody else in the room that doesn't know what a deferred comp or 457 is, think about a 401k. There's some caveats, but for all intents and purposes, think about it as being analogous to a 401k. So what you're able to do is put money away pre-tax into the stock market, have it grow. The drop program is really like a pension plan. So it's growing at a much lower rate of return. They're going to give you that 4.25%, 4.5%, whatever it is. Can you do better individually investing? And I think what it really comes down to is there's no 100% one size fits all approach. It depends what you want and what type of investor you are and what your goals are and what your risk tolerance is. If you are a very risk averse person, very conservative, very risk averse, you like guarantees, you like guaranteed income, participating in an income scheme for the rest of your life, even if it is only 4.25%, 4.5%, not a bad thing. If you want to, I call it mailbox money. If you want mailbox money, set it and forget it. It's never going to do any better. It's never going to do any worse, provided the fire department's around to keep paying the obligations. That's fine. What I can tell you is a lot of people that retire, for example, from the fire department do so at a relatively young age. And so they're not ultra conservative.
She'll be 57. I don't know if you heard that.
57, yes, still pretty young, right? So one of the issues is that, do you need the money right away? Do you need to turn on drop right away? Or do you want to continue to grow it? And if you have the risk tolerance, the appetite to grow it, and your time horizon is going to allow you to do that, then one of the most popular options is certainly looking at putting the money into a rollover IRA, or putting it in your deferred comp, or putting it into some sort of market correlated account where you won't have to pay taxes, because you can roll the drop right into a 457 or roll it right into a rollover IRA. And then you can then take control of it, take it by the reins, and try to grow it. Now, what are you giving up? You're getting potential increases in return, potential, but you're also getting potential decreases. If the market falls out, you have better staying in the drop program. But I will say, as long as your risk tolerance is moderately aggressive to aggressive, and you don't necessarily need guaranteed income, rollover IRAs are pretty darn attractive for a lot of people.
Now, even if, say, like in 2 years when I'll have my pension, I'll only be at 50%. Will that significantly, if I roll it all over, would I still have the same basically tax requirements for the deferred comp if all of that money basically essentially doubled my deferred comp from, roll over my drop into my deferred comp, and I essentially double the, the pool there? Would I have to have the same tax restrictions?
Great
overall?
question. Great question. So honestly, it should be 6 of one, half a dozen of the other, because your pension, you're going to pay ordinary income taxes on. Your deferred comp, it's all pre-tax. Most likely, you're going to pay all ordinary income taxes on that. So it should not change anything because you're not taxed on the value of the account. You're only taxed on how much you pull out every year. So whether you pull it out through a pension or whether you pull it out through a 457, it's as long as you put the same dollar amount, it's the same tax liability. Does that make sense?
Yes.
Thank you, Brian.
But
Jerry, sorry, go ahead, Brian.
And I will say I've done a lot of those. So we've seen a lot of pensions we roll them out and roll over IRAs quite a bit. For people that do on the younger side, unless again, you just want guarantees and you're risk adverse, then the pension provides a great mailbox money solution.
Perfect. Thank you, Brian. So I did message Jerry to text his question, but he doesn't pay attention. So, and he also doesn't have his camera on, so nobody knows. Jerry, go ahead. What's your question, buddy?
Well, you have control of my camera, and you turned it off. Now I can't turn it back on. So,
Perfect.
but anyway, So to piggyback on my fellow firefighter over there, retired firefighter, retired at 50, DB pension, all that's great. So my question is something a little different. Social Security. So I turned 60 towards the end of the year, working a full-time job. And my plan is to go part-time or whatever and start pulling Social Security at 62. And my wife is just like, no, let's go at 65 or 66, whatever the next drop number is. We'll just love to hear your intake. Of course, I'd love to hear where you tell me I'm right. And I know I don't have all the information you want, but because I love to hear that my wife is wrong, only because she's not around, so she won't hear it.
Sure. So
I will say Jerry's wife just wants him out of the house.
So
when I did retire, she definitely said, "Get out, go find a job."
Yep. A lot of this is a great question, and to solve the equation, we need to know one key important piece of information. Jerry, when do you plan on dying?
You know what? I'm giving it some thoughts. It depends on how much my wife is yelling at me.
Yep.
So one of the reasons I am calling quits at 62 is on my paternal side. The longevity is not great. 62 for my father, 63 for my grandfather, and his father, I believe, was 60. On my maternal side, it's a little bit longer. So not that has everything to do with it, but it's in the back of my mind.
That absolutely that was going to lead into my next question is family history. So a lot of times we have to look at our clients. We have to make our best guess. If you chart it all out and you start taking it before you reach full retirement age, so you're getting reduced benefit at 62 versus if you wait till 66, 67 years old. And really, it just depends how long you're going to live. If you live to 70, take it at 62. You made a lot more money. If you have a prevalence of early deaths in your family history, it's not a guarantee that you're going to pass early as well. But that's certainly something that any financial advisor would need to factor in. So if you're telling me you have early death as a life expectancy, let's say it's, the average person in your family tree has lived to 72, 73 years old. Yeah, I would tell you, take a look seriously at 62 years old and start looking at taking it out. Now, if you're going to defy the odds, it would have been better to wait till 66, 67. So a lot of it comes down to what exactly are your income needs and can you afford to let it go? Number two. And number three, your family history. What's the prevalence of mortality and young mortality versus old mortality in your life? It's a tough thing to figure out. What we do with clients when we're trying to answer this question specifically for them is we get a withdrawal plan in place. So we have to look at everything. What have you saved up elsewhere? Where can we be taking the withdrawals? And then how much of the delta do we need to fill with Social Security? If we can get by early on, you have a relatively long life expectancy, we can get by early on with taking money from other sources without triggering Social Security, we'll typically wait till 66, 67 years old to start taking it, sometimes age 70. For people, again, that have a family history that's problematic or do not have enough ancillary income or don't want to go out and work a different job, then yeah, turning it on at 62 could be a good option, but you are giving up a pretty hefty sum of money if you have a full life expectancy.
All right. Yeah. I mean, thank God my mom's still kicking. She's 87. Like I said, on the maternal side, it's the longevity there. On the paternal side, it's not so great. So it's kind of a 50-50 on that.
Then I would seriously consider trying to wait. If you can afford to push it back to 66, 67, I would recommend doing it because you will get a lot more money if you wait till full retirement age.
Interesting. Thank you.
It was great knowing you, Jerry. All right. And I'm muted him so he can recover. Who else? Who else has a question? I know a bunch of you asking. Yeah, go ahead, Nicole. You guys speak loud.
What's that?
You guys speak loud because the microphone is here.
Okay, so for the solo 401k, say you start getting employees, what's the time horizon on having to transfer those funds, and what are the options?
Yeah, so if you have employees, and one thing I kind of didn't talk about it on it, you just pointed it out, was that should not stop you from doing a 401k. So you can roll out a 401k where you, at the very least, can be putting away up to 23,500 if you're below the age of 50, up to 30,000 if you're over the age of 50, into a 401k. You can also make it available to all your employees. So let's say you have 5, 6, 10 employees.
She doesn't have employees at the moment.
So you would need, once you go and you start hiring full-time employees, you should stop the solo 401k. Now what we would put in place is a regular 401k. And a lot of small businesses, let's say you hire 2 employees, right? They're non-family members. You're like, oh, am I really big enough for a 401k? Absolutely. You can do it for really, really, really low cost. In fact, you can put the cost on the employees if you want to implement the plan. You also get a business tax deduction. You also get a business tax credit in the first 1 to 3 years for opening up a 401k for your employees. It doesn't mean you have to put any money in for them. It just means you allow them to put money into the plan. So you can still do it. So you do it for 1 year. It's November of that year. You hire your first employee. No, you're fine. You funded your solo 401k. Now you're hired your first real employee outside. The following calendar year, you would have to have a group plan, or you're no longer eligible to fund your solo 401k. But it's really easy to pivot a group plan and put it in there. We have a whole 401k team that works for me that does nothing but manages 401k plans. So if you ever wanted some free advice in that regard, I can hook you up with one of our guys that does 401ks, and they can kind of explain the nuances.
Very cool. Cool. Thank you, Brian. Anybody else?
I do.
Go ahead, Timur.
I have 2 actually.
2 questions. You get 1.
You get 1. What do you invest in?
So are you asking me personally? Or are you asking for my clients, or who's the audience?
Personally.
Personally, oh boy, that's a question not many clients ever ask me. So you know how I was telling you not to invest in individual stocks? I do have a number of individual stock positions, but the vast majority of what I invest in is the exact same thing I invest in for my clients. So people might like crypto to be their speculative position in the portfolio, about 10%. I personally like individual stocks to make up to 10% speculative investment in my portfolio. Right now, Palantir's done really well. We're like 80% year over year rate of return. There's some other high flyers out there. You know, you've seen your NVIDIAs, your different things like that. So I do have a speculative part of my portfolio that I will pick some of these, you know, these names that are just high flying names, but they also come with a lot of volatility. 90% of my portfolio is made up of probably less than 20 different ETFs and mutual funds. The ones I use, I'll give you a couple names. I like CGGR is a really good one. That's the Capital Group Growth and Growth Fund. The CGDV is Capital Group Dividend Value Fund. Blue Chip Fidelity has a great Blue Chip Growth Fund. Anything by Capital Group has historically done very well. VTI, Vanguard Index Funds, have done historically very well, and they have very low expense ratios. But personally, I like to have broad market exposure to technology, to the S&P 500. I'd say if you look at my concentration, where I'm investing, heavily concentration in the S&P 500. Second would be probably technology. So you're talking large cap stocks, growth stocks, technology stocks, and then beyond that, dividend paying high value stocks. So stocks that particularly have a history of paying dividends, meaning they're sharing profits with the stockholders. They have a lower price to earnings ratio, which is a way of measuring what their stocks trading at compared to how much money they're making. And I typically eat my own cooking. So what I'm putting my clients in is what I'm doing personally, with the exception of the 10% of the individual stocks. Do I own crypto? I get that question a lot. I have a very small crypto position, not for any reason other than for me to monitor what's happening in the cryptocurrency space.
And Barry, you mentioned Warren Buffett before and some of the things that he said, and he did buy individual stocks. But one of the things he said, he only buys stocks of companies that he's very familiar with the industry.
Yep.
So he needed to know what's going on.
Yeah, you know, so BK, it's great you brought that up, because this has been sort of the old adage where you hear people say all the time. I have new investors come to me and they're like, I've always heard from some so-and-so, grandfather, father, whoever it was, mother, buy what you know. That can be good advice. But just because you know something doesn't make it a good investment, right? You may wear Under Armour every single day to work out, and I may still tell you, I don't want to touch Under Armour with a 10-foot pole. You may still, like a particular Pinterest or something like that. And I remember when Pinterest IPO came out, and it went up like this and fell down like a rock. And I had clients call me and say, I'm on Pinterest all the time. I want to buy their stock at the IPO. And thankfully, I held them off for a while. It's done pretty well after that. But it's not always just investing in what you know, unless what you know is also a company that's being run very well. So you look at Warren Buffett, for example. He bought. Let's look at Sea Candies, or we can look at Coca-Cola. Would be a great example of a stock he's held for just ever. It was a product that he loves. He drinks a few Cokes every day. He's 90 some years old, 98, 90, 97, 99, whatever he is now. And he drinks several Coca-Colas a day. He eats McDonald's pretty much every day for breakfast. I mean, the guy is like the exact opposite of what every doctor would ever tell us. And he's lived to an old age. So he knew Coca-Cola, but it wasn't just him liking Coke. He went in, he met with the management team. It was a cash flowing business. It was a business that had mass market appeal. It was a sweet beverage business. I actually read Charlie Munger's book, which I, believe it or not, have right here. That talks about their investment with him and Warren Buffett originally in Coca-Cola, for example. So it is about buying companies you know, companies you like, but also you have to make sure that those companies are high performing management teams. They have a good moat around them that's exuding competition. They can't easily come in, replicate what they're doing and doing it better. There's certain keys to that. So it's not what I always hear from people, invest in what you know, yes and no. Invest in good quality companies. It's a bonus if you are also a customer of that company.
Well, thank you for clarifying. And Timur, you had a second question? I'm sorry.
So I'm just new to the 401k stuff. So what's obviously you're not volunteering. What's your take on that? Just trying to figure out. Well, you work on percentage, or how does it work?
My take. Oh, okay. So what do you get paid? So most advisors that work with clients, there's different ways for financial advisors to be compensated. Historically, if you think back to like the Wolf of Wall Street, if you guys have seen that movie, they were making money off commissions. So they were calling people to sell them a stock to make commission. That used to be the way that money was made by financial advisors, traders, things like that. And obviously anyone that's a financial, well, not anyone, but most financial advisors like myself are also licensed traders. You kind of have to be, and if you're doing a lot of different things. That has largely gone the way of the dodo bird, so to speak, and become less and less prevalent. What most advisors do now is they act in a fiduciary capacity to their clients. So, and I shouldn't say most, but firms like ours, we act in a fiduciary capacity when we're managing people's assets. What does that mean? It means by law, we have to act in your best interest above our own. We also do not charge commission on investments. So if it's if I'm opening up a brokerage account, an advisory account, or if I'm opening up a solo 401k, the typical fee my firm charges is 1.05% of the assets we're actually managing for you. The market average is probably about 1.5. We personally undercut the market, not because we're less valuable, but because we have such a high retention rate. Our goal is to build lifelong relationships with clients, not have a client for 2 years and have them leave us for someone that's a little bit cheaper down the road. And what you'll see is as the value goes up, most firms will reduce the percentage they're charging you. For example, our fee drops as low as 0.3% for account values over about $10 million. So it's usually, if you find the right advisor, you should definitely find someone you like and trust, right? First and foremost. Secondarily, that should be their fee. And you should look at how they're charging you. What are they charging you? If they say, oh, there's no fee at all, in my opinion, run for the hills. That means they're charging you a commission. You are no longer the client, you are the product. They are calling you to make a sale to earn commission for themselves. If you work with a true advisor, they're either going to charge you a flat fee, which is whatever X thousands of dollars per year, or they're going to charge you what we call an assets under management fee, which again is predicated upon how much money they're actually managing for you. And then if the market does bad or if the investments do bad, that advisor is getting paid less too. So it puts it aligns your interest all in the same sort of bucket, if you will. Does that make sense?
Yes. So does that, so let's say I invest $1,000, you charge off of that, or like say in
whatever is in the account.
years,
Whatever's in the account. So my goal, and what any good financial advisor's goal, it's a fiduciary should be, is if they're charging an AUM fee, assets under management, is they want to grow your account absolutely as well as they can.
The more money is in your account, the more money he makes.
Right?
Yep.
Is it charged? Well, is it calculated annually?
Great question. So typically it's charged quarterly. So what happens is the broker dealer, custodian of the money, whoever you're using for the custodian, my firm uses a company called LPL, which is the largest independent broker dealer in the country. They have, I don't know, 20 to 30,000 advisors who use them. They have like $2 or $2.5 trillion or something like that under management. They're huge. We have them custody and hold the money. That way, if a bomb dropped in my building, I got hit by a bus tomorrow, my client's money is unaffected. I forget where I was going. Sorry, I had a point that I was going to make.
Quarterly commission.
Quarterly commission. So what they do is they charge quarterly. They take the money out of the account. So they'll take a snapshot once a quarter. They'll take the money out. The advisor typically gets paid on a monthly basis in the arrears. LPL holds the money and then they pay it out to the advisor, but it comes directly from the account.
Okay. But it's 1% total per year.
Per year, 1.05 per year. So they're taking out increments of roughly 0.26 per quarter.
Yeah.
Yeah, no.
All right, take it to more. Tom?
Yeah, if I call you, do I get you or a young associate as my advisor?
Great question.
This is coming from an attorney.
So so you know how it works then. If you're an attorney, my goal is to bring the clients in and then never talk to them again. Just like a partner does a law firm. No, I'm kidding. It really depends. So if it's a good fit for me, partly what it does depend on his asset level. How much assets you actually have is whether you work with one of our partners or one of our associates. We are a team. Most of the people that I'd be talking to, like a BK said, hey, Brian, I've got a friend. I want you to work with them. They're only talking to me. They're not talking to any other associate. I don't care how much money they have. I don't care if they've got $7,000 to put into work once and that's it. I'll do it because I like BK and I love working with BK. For most of the time, I won't work with a client unless they have $1 million to invest with me. Unless it comes from a good referral source and it's a client that I like working with.
Or a dead agent.
Like BK. Or a dead agent. That was BK. A little side note, just so, and everybody else may appreciate this too. That was the first and only time we ever agreed to take the clients of a deceased agent that was with an insurance company. We had the insurance company contact us, Mass Mutual in that example. And they were like, hey, you guys do a lot of business because we do insurance as well. Would you guys mind, we had an advisor die, would you guys mind taking over his clients? And we said, okay, well, maybe there's an opportunity here. BK, you were one of 2 clients that I kept out of about 2,000. We gave them all back. We said, we don't want any more. But I like working with you. So that's how, so to put it in perspective, yes, you can get to me from a dead agent, but we don't take any more dead agent stuff anymore.
That's a general good rule for life, by the way.
Yes. That is the question.
Sorry, my wife has a question.
Oh, this is really good. The life insurance?
I was waiting for her to ask that. Yep. We can go through all that.
By the way, so
all of us want
Brian,
to
let me change to gallery view so I can see everybody. Do you see my wife? Because she's hidden behind right there.
I can see her now. Yep.
She's the signatory on all my benefits, right? She knows I'm worth more dead than alive.
Exactly.
I was just asking if I just get you by proxy. Do I
Yeah.
I keep telling her she needs. Well, so this is a good question. We're talking about rolling different retirements. She has a 401k from an old employer, which she hasn't been with for years, but the money's just sitting in an account. I said, you should just talk to Brian and just roll it all over and have him do it.
Yeah, you can leave it there. You can cash it out. You can put it in a new employer's plan, or you could definitely do a rollover IRA. Rollover IRA is by far the most popular. You're taking it out of an old employer plan. You're putting it into an individual account that I or any financial advisor yourself can manage for you.
Cool.
Where's it physically located?
You're in Hunt Valley, right?
Hunt Valley. Yep. We work nationwide. We're actually in 49 states, and it took me until this point, about 4 hours ago, I actually figured out what state we are not in. None of us knew. It's Idaho. Idaho's the only state we're not in for no reason other than we don't have any clients there. We're in 49 states, and Idaho's the only one we don't have a client in.
For you.
No, but I'll tell you, Brian. So, and again, not trying to to blow smoke up his ass in a sense, but the first time I met him, I used to live in Baltimore County. I already lived a deal. I went to his office. We sat there, as I said, and he's took all the time in the world to explain to me what's going on. But we meet virtually, and I because that's just me. You guys know me. I just like to know what's going on. I'm like, Brian, can we get on a call and just see what's going on, what's coming ahead, what should we change, leave the things the same, just touch points. So you'll do a lot of things virtually. Obviously, a few things have to be done in person, I assume. Or actually, nowadays you can sign documents in virtually.
Yeah,
as well.
everything's signed. We do a lot of Adobe Sign and DocuSign for the documents. I'm always happy to meet people in person or remotely. Remotely has been something new. We started really during COVID out of necessity. And we found out that our clients preferred it. And 9 times out of 10, they prefer to meet virtually because it's less intrusive for them. There's no travel involved. For us, it's much more efficient to meet with the client virtually and versus traveling to the client. So what we have a preference for in most cases, unless there's outlying circumstances, is having the client either come to our office or meeting virtually with them. But we work nationwide.
Cool.
Very cool.
Anybody else? Yep.
One.
Go ahead, Curtis.
When it comes to finding a financial advisor, I know for the company I work for, they kind of give you like, I guess their preferred, like ours is a Greenspring advisor.
I know the owner of Greenspring, Pat Collins, pretty well.
Okay,
He's a buddy
it's
of mine.
like if your company gives you like that option, are they usually good options to go with, or would it be worth going out and seeking an individual opinion like yourself or someone else?
Greenspring is the preferred advisor, most likely because they manage your company's 401k plan. Am I correct?
Yes.
Yeah, Greenspring's niche, and Pat Collins, a great guy. They have a great operation over at Greenspring. I've known Pat for a number of years. He's actually one of my business partners' best friends. So we've let's just say we have a great relationship with them. So I'm going to watch what I say about Greenspring. Greenspring is a good choice if you're looking for financial advice. There's nothing wrong with Greenspring. I will say their focus, however, is 401ks. That's kind of their niche. I don't think they do as much individual financial planning. So they do more of the employer side, group side, whereas my firm's niche is definitely, I'd say 3/4 of what we do is on the individual side, 1/4 of what we do is on the big group side. We have a whole 401k practice, but if I'm just thinking about it from a revenue perspective, probably 80%, 75 to 80% comes in from an individual basis. We have a lot more individual clients than we do corporate clients. So our niche is more of an individual. If you ever want a second opinion, I don't care who your advisor is, even with a quality advisor like Greenspring, it's never a bad idea to get a second opinion. You shouldn't have to pay any fee for a second opinion.
Okay.
Cool. Brian, this was a little bit longer than most of our calls, but I appreciate all your time. This was super insightful, and I truly appreciate your time and joining us. If people want to get in touch with you, what's the best way to do it? I mean, I can share your email, but
Email's ideal. Cell phone, email, but email is definitely ideal because my schedule fills up pretty quickly, and so it's a lot easier to get me if I have time between meetings. Throughout the day, I carve out windows of time where it's done nothing but responding to emails and trading accounts. So emails, Brian at RBJ Wealth, BK has it. And again, if it is anyone from this group and BK, if you tell me on the side, hey, this person's a jerk, you don't want to work with them, you'll get an associate. But otherwise, if it's someone from BK,
I'll let you know.
Yeah, if it's someone from BK, it would typically be working directly with me.
I'll be honest, Brian. If they're a jerk, they probably got punched in the face by me. So we're good. All right, Brian. Well, I appreciate your time. Thank you so much. And I'm gonna post this on our internal group. This is not going outside, but I'm gonna send you links if you ever want to use it. And I was look forward to talking to you soon. Thank you.
I really appreciate it. Thank you all. I'm sorry if I rambled on a little bit, but hopefully you learned a little bit.
Take care, bud. Bye.
Okay.